Hello and welcome to State of the Economy. Today we have with us Dr. Saumitra Chaudhuri, who was member of Planning Commission in the UPA regime, as also a member of Prime Minister Manmohan Singh's Economic Advisory Council. He's a very keen watcher of the economy and currently also a columnist with the Economic Times. And he has been writing a lot on what is going on in the Indian economy as well as in the global economy. He's here with us to discuss the outlook for 2016, both world and Indian economy. And as you all know, we've begun the new year with a big scare. The Chinese market crashed by 7%, and it's sent a shiver across many other emerging markets as well as the developed markets. We had the impression, the consensus in the beginning of 2015 was that the worst was getting over and economies across the world would recover on the back of oil prices halving, which would put a lot of money in the hands of the consumers. One estimate was $1.5 trillion coming to the hands of the consumers. But the end of 2015 seemed to suggest that some of those hopes were belied. And even the Indian economic policy makers are reviewing their early 2015 forecast to suggest that things are not all that happy with the local economy. To discuss that, we have with us Dr. Saumitra Chaudhuri. Welcome to our show. Saumitra, you in some ways, you've been forecasting some of those risks which are now being seen more clearly. You spoke about deflationary trend in the Indian economy surfacing for the first time in many years. So tell us, what's going wrong? Even policymakers are kind of reviewing their forecast. They are reassessing some of the assumptions made earlier. You've also been writing about some of those things. So tell us what's going on.
You know, whenever something which is not nice, like the current economic slowdown, and it is a slowdown, 7.2%, I suspect is not very a faithful picture of what's happening. It's a bit misleading. It's a slowdown. Slowdown lasts for a long time. It accumulates problems. We started slowing from about 2011, certainly from 2012 onwards. Yeah. And then now it's 4 years, almost 4 years gone. And that has made, accumulated a lot of problems in the system, number one. Number two, I think when the new government was sworn in, Mr. Modi came in with a lot of public support, a lot of enthusiasm. There is a possibility that he could have hit the ground running. And, you know, there could have been a pullout from that accumulated problem. That didn't quite happen. Third is, yes, I mean, oil for us is a huge issue. Commodity prices are, all commodities are down from wheat to iron ore, and also oil is down. When oil is down, typically it's good for us because we import a lot of our oil, so it has three effects actually. One on the inflation, secondly on the trade deficit, and thirdly on the government's fiscal balances because government does subsidize willy-nilly some amount of the oil consumption.
All that did happen actually.
All that did happen, but we sort of didn't give us the kind of fillip that we should have got.
That's the key question. Why haven't we got that boost?
Reason essentially lies in the engine for growth, which is the organized sector. I think that's where the real issue of slowing has a kind of a very dominating effect on the rest of the economy. If you look at company results, for instance, you'll find that the top line, which is the net sales figure, is growing on an average between 4 and 6% in the last 2 quarters. That's pretty low. Much lower than, let's say, what the real growth is being reported. If you look at EBITDA, which is the gross margin before interest and depreciation and taxation, EBITDA rates have declined in the last 3 or 4 years, is not showing much signs of improvement, though it has not showing any signs of getting worse either. One must admit that. But EBITDA in absolute terms is negative. That is, people are actually making less money before interest, depreciation and tax than they were making a year ago. That's something which is serious.
So there's a negative growth in EBITDA.
Negative growth in EBITDA. Now, this is for an aggregate.
Can I make a small intervention here?
Please.
Because it relates to an article that you wrote where you picked up government data on from national accounts to show that the GDP deflator is actually negative for India. Now, assuming that GDP and the deflator negative was at what, 2.2%?
1.8%.
1.8%. So if the GDP is growing at say 7.2, so it stands to reason that a negative deflator would mean nominal GDP would be lower than that?
Yes, it would be lower than that.
So I've spoken to some industry people, and they are saying that typically their earnings growth is about 0.7, 0.8%, 80% of the nominal GDP growth. That's what their earnings growth normally is. So that means they're suggesting that earnings growth would be around 5% going forward.
As I said, it's been 4 and 6%.
Yeah, you're right. So that's why it stands to reason. What they are saying, it corresponds with what you just suggested.
Normally, in an economy is doing well, EBITDA actually grows faster than the nominal GDP. For instance, in the Media Economic Review, we published some days back called the boom years, EBITDA growth was typically between 20 and 30%. Year on year. I mean, if profitability is strong, only then private companies will invest in fresh assets. If the existing assets are giving them not enough profit, in fact, declining rates of declining profitability, why on earth would they actually invest in new assets? The deflator becomes very important, and let me just
I wanted to explain to our audience what exactly does this deflator signify?
You see,
negative deflator.
In the 1980s, in the good old days of regulation, when we had regulated interest rates, IDBI used to lend at 12.5% to everybody. Manufactured inflation was 12.5%. So industry saw this actually the zero interest loan. Because if you took a loan, you paid 12.5% interest is true, but the products that you made actually appreciated in value by 12.5% every year. So in fact, you paid no interest at all. That of course changed in the subsequent decades. Now you have a situation where your interest rate is X, whatever it is, say 7, 8, 9, 10, 11, 12, wherever you borrowed it from, and your actually sales growth is much lower. When that happens, essentially your interest rates becomes phenomenally punishing. Phenomenally punishing. And under those situations, not only that, there's a real risk that after some time, the principal that you have borrowed actually has become even more costly in terms of the goods that you produce.
And reflecting in terms of banking sector,
it'll always
non-performing assets.
No, basically what happens in that situation is people don't borrow anymore. In fact, this is one of the reasons probably why credit growth has been so slack. Of course, credit growth has also been slack because companies are leveraged very heavily, because the interest cover is lower. As I said, EBITDA, the interest, on the average, interest subvention as it's called, how much EBITDA goes towards interest, used to be about 12% 3 years ago. It's about 25%, 25 to 27% now, and that's remained valid for the last 1 or 2 years. So when you have such a high subvention of interest, you really are not in a position to borrow very much more. So you therefore don't have much investment. There is some investment, but not much investment.
So let me just simplify further what you just said. Essentially what you're saying is if a corporate house has to borrow at say 10% or 10, 11%, a good corporate house, AAA, others of course would borrow at 15, 16. And if their earnings growth somewhere between 4 and 6% as you suggested, lower than the nominal GDP growth. So it doesn't make sense for a company to borrow at 10% when the earnings growth forecast is not above 5 or 6%. Is that what you're saying?
Yes, not only that, you see, there are two classes of investors. There are the people who give the loans, the banks, and the bondholders, and then the shareholders who own the equity. As long as, earnings growth is more than the interest rate, the equity shareholders looks to make some money. If it's the other way around, equity shareholders get squeezed and equity shareholders take the risk. So you tell me, what sense does it make for me to invest more money when whatever little cash I've got, if I put it into, let's say, a debt fund or into a bank fixed deposits, I might be better off. So this is classically the situation where interest in investment, new investment declines, conservation of cash becomes important, and actually the risk appetite really plummets.
So Saumitra, the next question then to ask is, should interest rates be now brought down drastically? Also, in view of the fact that that we are facing a very peculiar situation where producer prices are are facing deflation, whether you take agriculture or manufacturing, and consumer prices are still showing about 5 to 6% growth.
You see, again,
Now, this dichotomy, you've been watching the Indian economy for now many decades. Have you ever seen this kind of a dichotomy, that producer prices and consumer prices completely diverging in this manner, making monetary policy, making also very tough, or even making other policy also tough, you know?
I don't know how tough it is to see the truth, but consumer prices have historically generally been ahead of wholesale prices. And the reason for that is consumer prices, the base is heavily weighted in favor of food. About 50% is food, and all the rest of the stuff is much less. Part of the reason being the National Sample Survey's consumption expenditure, upon which the CPI is based, misses, underreports the consumption of manufactured goods and modern services. So now, if that happens, you could get a situation like we are having today, where the wholesale price index is negative, where all producers of goods are actually saying that their prices are actually lower, selling prices are lower than it was a year ago.
And they don't have any incentive to invest?
They have no incentive to invest, but the CPI sort of has its own autonomous trajectory, which is reporting something. Now, one more thing that I think I'd just like to say, yes, interest rates should be adjusted according to not just what's happening to inflation, but what's happening to growth. The problem is, the headline GDP growth number, 7.2, looks quite impressive, but if you sort of see what its implications should have been in terms of corporate sales, other activity, those are somewhat missing.
Yeah.
So,
in fact, most people do not believe that we are growing at 7.2%. They say that 7.2% of today is not the 7.2% of the previous GDP series. You know?
If you look at the last series, previous data series, the growth rate for 2013-14 was regional GDP
was 6.9%.
Was 5.0%, and that got lifted to 6.9%.
6.9%.
Now, there has always been a tendency in our system to initially underreport production, and then later on, GDP numbers have been revised upwards, but 1.9 percentage point is a huge increase. So it does color, perhaps being part of having worked with the UPA government, I might bank 2013-14 more handily. Certainly 2013-14 was not 6.9% growth as we know it. So I suspect that the same might be true for subsequent years.
Yeah. So you're saying that 6.9 for 2013-14 might have been an overestimate.
Might have been excessive.
Now tell me, you also
might have been more.
You meet people, businesses on the ground, and that's also part of your job. You, as a macroeconomist, you also try to assess how businesses are doing. What is your sense? What you hear from them, does it match the 7.2% growth that national accounts show?
They ask me this question. Where's the 7.2%? I don't see it.
They do ask you.
Now, if you look at some of the other numbers that we've got, which are not very often widely discussed, numbers on hiring. We don't have much data. We never had data on near period hiring. But in 2008, at the height of the global crisis, we instituted a new survey. It's not an exhaustive survey. It doesn't cover all industries. It covers 8 industries, including IT, BPO. And if you look at that data series, data is available as of today only up to March 2015. It shows that during the recovery from the global crisis, our new hiring, and the average was almost 3 lakh people per quarter. So every quarter, almost 3 lakh people were getting jobs in these 8 industries. That came down in 2012 and 13 to about 50, 60, 70, 80,000. In 2014-15, April to September, the first half, it picked up. It picked up to almost 1.5 lakhs, so that's certainly an upturn. But thereafter, the next 2 quarters, was back to about, in fact, last quarter was only 65,000.
So it's back to where it was in 2013?
12-13, Bude Din, back to Bude Din.
Back to Bude Din, huh?
So,
in employment terms.
Employment terms, unfortunately, that is true. We don't have numbers for this quarter, and I think, I really wish things would turn around, because the people who really would pay the price if the economy doesn't recover are the young people who are coming out of schools and colleges, looking for jobs and business livelihood, many of them from farming backgrounds. And we had promised them that they would actually, if they educate themselves, that they would have a future in the modern world. And if we cannot deliver that, it's a collective failure.
Tell me, Saumitra, how much would you attribute again, this is an ongoing debate. This debate was pretty much there even 2013-14 when there was a big slump in growth. Debate was about how much is it due to global slowdown and how much is it due to policy paralysis. Now I'm hearing a new term. There's a corporate sector paralysis as corporate sector is not investing. Now, in the current phase, how much of it is due to the current slowdown, due to, say, the Chinese economy slowing, commodities deflation, commodities, many commodity companies are not investing because commodity prices have nearly halved, 40%, at least 40 to 50% fall in many commodities. So, so what is your assessment? How much is due to global factors? How much is due to domestic factors in the current phase?
You see, when globally things do well, it's like the old saying about when high tide raises all boats.
Yeah.
Everybody does a bit better. And when the globally things go sour, everybody hurts a bit. But let's look at 2008. That was the year of the global financial crisis, when the developed world went into a real tizzy. We did reasonably well. We had suffered for about a half a year or 9 months actually.
I think we had 10% growth in 2010-11.
Yeah, by 2029, in fact, we are out. As I said, the second half of 2009, hiring was already picking up very strongly. And in fact, in one quarter, we hired almost 800,000 people in one particular quarter of these 8 industries. So, it did pick up very sharply. So, yes, we also suffered because we also caught a cold because of the global fever, but we didn't go under. So, what happens globally is not irrelevant, it's very relevant for us. It affects financing, it affects trade flows, it affects so many things, sentiments. But if we can to some extent, I'm not saying we can exercise complete autonomy, we can exercise certain degree of autonomy. And I think what has happened let's say in the last 2 or 3 years is that international investors, for a moment let me borrow their terminology, is that India is going to basically distinguish itself from the other EM markets, other emerging markets, is going to do better. So India is going to be in a category of its own, will do significantly better. But as the years progress, didn't happen.
It didn't happen, yeah.
And when the new elections happened in 2014, I think there's again a feeling that India would be able to distinguish itself from the other EM markets, and India would actually have a different trajectory from everybody else. Again, that did not quite happen. So we are now lumped with everybody. So yes, as the global factors have a big effect. But how you play domestic policy, how you actually implement policy is probably more important than actually having the policy. How you implement the policy makes a huge difference, gives you some amount of
There's a lot of disappointment with domestic policy too. At least that's what I gather when I speak to businesses. They're saying that this government did make some effort. I mean, it's not for want of effort, but it didn't go the whole hog. It made so many promises on the reforms
I think
front,
there's a bit of...
but didn't happen.
Bit of absence of coherence. I mean, it's something that, not that, I think the intentions are all possibly right, but there's an element of coherence which is somewhat lacking. So how do you translate first of all, how do you diagnose your problem? How do you then have a craft a policy to fit the diagnosis? How do you implement the diagnosis on the ground? I think in many of these things, there was lacuna. And I think, essentially, these have to be substantive issues.
Tell me, I want to ask you something here. The core strategy of this government, outlined by Finance Minister Arun Jaitley and many other economic ministers, was since private investment was not picking up, growth should be driven largely by public sector investments, and a lot of allocations were made in the 2015-16 budget. And also, the government appropriated a lot of the fall in oil prices as part of tax collections in the hope that some of those could be spent on infrastructure or pushing public investment driven growth. Are you satisfied with this strategy playing out, or whether it's playing out right, or what's your sense?
Public expenditure has a lag. And if you've worked, I've worked for a bit of my life in government, I know that there is a lag.
Yeah, you've done a lot of work in the government.
I worked for 10 years in the government. I know there is a lag. A lag is something.
And I remember in 2012, a similar strategy sorry, in 2009, after the global crisis,
I tell you,
there was a similar strategy
2008,
put in place by the UPA also.
Still, I remember 2008. Some of us, myself, Dr. Rangarajan, Mr. Chidambaram, and the Prime Minister supported that. We went for tax cuts. The reason we went for tax cuts is that tax cuts happen immediately. The effects are immediate. There was an argument made, a very strong argument by professional economists, some of them actually who are now rooting for the current government, that expenditure is a better tool. And I remember having a huge argument. I opposed it because I knew expenditure would be lagged. It might be in theory a great tool, but because expenditure is going to happen 1.5 years later on, it's going to have no near-term effects. However, one particular item of expenditure we agreed with, not because they said it, but because the department said it, which was more buses, low platform buses under JNURM.
Under the JNURM.
You know when the buses were order was placed? Almost 2 years afterwards. So what do you do? Because in the government system, decisions just take time. They have to go through this procedure, have tenders, tender evaluation, bidding, God knows what all.
So you're saying that
by the time the buses were delivered, economy was racing. So what we did was the right thing. We did use taxes. We didn't use expenditure. So today,
tell me, so again, in today's context, do you think it would have made more sense if the government had passed on the entire oil price fall into the hands of the consumer and waited for a consumer
I think the government did the right
consumption-led growth?
I think the government did the right thing in there. Two reasons. One is that if you absorb it through taxes, there are two implications of that. One is that, yes, you can finance higher expenditure. Secondly, tomorrow when prices goes up and everybody demands that government should absorb prices, there will be at least some cushion to absorb it.
Even oil prices, when they go up, then there will be some cushion to absorb.
So I think it is a wise strategy and I'm very happy they did it. But expecting public expenditure to lift the economy, the problem is the lags involved. You can decide to want something to do today, it just takes a long time.
So basically you're saying that unless private investment also picks up.
Private investment has to pick up. If you look at the last 20 years data, the contribution of public investment to growth has been more or less the same. Ratio of public investment to GDP has been more or less the same. It doesn't change.
So the delta always comes from the private sector.
Delta comes from the private sector. If you are not able to get that going, you're not going to have a resurgence of growth.
Thank you very much for talking to us, Dr. Saumitra Chaudhuri. That's all we have in this edition of State of the Economy. We'll be back with you next week. Thanks for watching.